Hello, everyone, and welcome to Buck Stops Here. I'm Catherine Murray, and welcome to our first show of 2026. I think it's always important, from my perspective anyway, when it comes to investing, to really have kind of a top down macro view of where we think we need to be positioned for 2026 and almost always. And for that, we have a great guest joining us today. His name is Matt Orton. He is the Chief Market Strategist at Raymond James Investment Management. Matt, great to be with you today and setting 2026 in terms of the outlook and the strategy. So thank you.
Likewise, it's great to join you, Catherine.
Why don't we first start, as I mentioned, kind of your top-down macro view? And of course, so many strategists wrote their views prior to the capture of the Venezuelan president only a few days ago. Did that change anything for you, or how are you even interpreting that as it relates perhaps to risk in 2026?
Yeah, it's a key question a lot of clients have been asking since we just came right out of the gates in 2026 with some geopolitical catalysts. But I would say it doesn't really change the fundamental perspective. Heading into this year, and really the main message that I gave to all of our clients coming into 2026 was a message of optimism that's predicated on resilience. And I'd say there's resilience across global economic growth. We're seeing that play out not only in the US, but around the rest of the world, from other developed international economies to emerging markets. We're seeing resilience with respect to corporate profitability in the face of questions around tariffs and persistent inflation. We're seeing resilience with respect to profit margins and the ability of a consumer to spend and the labor market overall. So there's a lot of reasons to be optimistic. There's certainly a lot of risks as we get later into this cycle. And so I think from a top down perspective, the main message is that you want to use downside opportunistically. I think you want to structure your portfolio so that you're leaning into some of those key growth trends that are working, like artificial intelligence, like growth in general. But now's the time to start complementing that with perhaps some rotational opportunities, whether that's international markets, cyclicality in general through financials, energy, industrials. And I think that's going to be the winning playbook for 2026.
Interesting, and it's amazing too, coming off such strong years in the United States, those markets, Canadian markets, and also international markets, which I think caught a lot of people by surprise. I think for past couple of years, people kind of ignored the international markets. Uh, but what do you see now? Do you think that that performance can, in fact, continue for those perhaps who have missed it?
I think it can. Whether or not international markets outperform the US again, especially to the degree that they outperformed in 2025, I think that's a little bit more questionable. But I'm certainly optimistic that we're going to see solid performance across international markets, and perhaps maybe a little bit more bifurcated based on what the trends are that are driving the fundamentals. So you take an economy like Canada, or in a market like Canada, where I think a lot of investors after Liberation Day thought there's no way that these markets can outperform because of their reliance on the US and tariffs. But the idiosyncratic drivers of corporate profitability weren't so related to that. You had the metals complex driving returns in Canada. You have financials that continue to do well and capture more market share and wallet share on the wealth management side of the business. There's also AI names in there. And that remains the case for a lot of other markets around the world. So I think it's going to be success overseas is going to be much more based on what the fundamental drivers of that earnings growth inflection look like, as opposed to just
Mhm.
taking a country and thinking it's going to outperform or underperform. So, as a stock selector, as an asset allocator, that's a really exciting place to be because you can add value based on where those opportunities lie.
Right. To me, it's always an exciting time to be someone who works in the markets because you actually get paid to do your homework more, to actually do the analysis versus just buying a broad ETF. I think that it makes it so much more interesting. Just quickly here on gold, because that is one of the key drivers of the Canadian markets last year. Do you think it will continue to drive them higher this year, or does gold continue to have upside?
I think so. My price target for gold at the end of 2026 is 5,500. So I'm quite optimistic on where the precious metal goes. I think it's predicated both on fundamental supply demand drivers from central bank activity and this continued de-dollarization, or really, I'll say, fiscal profligacy challenges that investors face. But also, a lot of retail investors are still underexposed. I view it as a very good ballast to more pro-risk asset allocations in portfolios. So I definitely think investors want to use any more pronounced downside to their benefit.
Okay, we'll take a quick break. We'll be right back.